Interest rates are the highest they've been in nearly 20 years, but there's a cool new program that'll help certain borrowers lower their interest rate, which effectively lowers your payment and keeps more money in your pocket. So let me walk you through what that program is, who qualifies for it, and how you qualify for it. So let's jump into it. Hey, what's up guys? I'm Ben Sun. Welcome to my channel. If you've been here before, welcome back. If this is your first time, welcome for the first time. I don't just talk about fighting insane interest rates. I also talk about improving our overall financial health through things like personal finance, investing, and real estate. So if that intrigues you, you gotta hit that big red subscribe button. Let's talk about what this program is. This is a program that helps reduce the rate and fees for certain borrowers. I'll talk more about that in just a second. But this is a program that is going to be applied to one of three conventional programs. It's automatically applied, so there's not really anything that you have to do. And pretty much every lender is going to offer it, but you don't want to just automatically assume that you're going to be placed. You're going to want to talk to your lender about qualifying for one of these programs. These programs are going to be one of three conventional programs. It's going to be your Home Ready, your Home Possible, and a standard conventional mortgage. So let me quickly walk you through what these are. The first two programs are the Home Ready and the Home Possible mortgage. These are a lot like a regular conventional mortgage. They allow you to put 3% down, but you have to qualify based on your income, meaning you can't make more than a certain percentage of the median area income in order to qualify. I'll explain this more in just a second. I have a lookup tool in the description down below, and we'll take a look at that so you can see what you have to look out for, because it's pretty simple. And one of the other things is that you have to take a home buyer training class. It's a free online class. It only takes about 45 minutes, and you have to do that before you close on the mortgage. Again, your lender will help walk you through this, but it's one of the only other requirements that are different from, say, an FHA, VA, or some other standard conventional mortgages. A couple advantages of these programs, aside from this rate reduction that we're going to talk about, is that you generally get a lower interest rate anyway. You have lower fees and potentially lower private mortgage insurance, which is a monthly fee. And you have lesser down payment than, say, a 3.5% down convention or a 3.5% down FHA mortgage. All right, and so as you can see here, this is our lookup tool. And now you can type in any city or state that you would like, but let's go into Detroit, Michigan. This is gonna give us an idea of how much you need to make per county or per area. And as you can see, it'll be sort of neighborhood specific, but this will give you a good idea, and it'll tell you exactly how much you need to make or the limit that you can make for the area that you're looking to buy. Now, if you're gonna go the Home Ready or Home Possible route, you can go up to the 80% area median income. And as you can see here, it'll literally tell you 80% area median income, $72,640, and it'll directly tell you that is the Home Ready income limit. Now, the other program is a standard conventional loan, and a lot like Home Ready and Home Possible, you can put 3% down. In order to get the rate reduction, you do still have to qualify based on your income, but it's a little bit different than the Home Ready and Home Possible, because instead of qualifying on 80% of the area median income, you can utilize 100% of the area median income, meaning you can make more for the same area that you were going to borrow in. And in high cost of living areas, you can go up to 125% of the area median income. The only downside here is that you have to be a first-time home buyer. So a first-time home buyer is someone who hasn't owned a home in the last 3 years, meaning you can't be on title to a home, you can't have owned a home. So if you sold your home 3 years ago and you've been renting, then you would qualify. If you co-signed for someone and they still own that home and you're still on title, you're considered a homeowner, and so you wouldn't qualify. Oh, and one of the best parts about this program is that they can be combined with down payment assistance. Check out this video on how to find down payment assistance in your area, after this video, of course. With all three of these programs, you have to be buying the home as a primary residence. It can't be a second home or a rental property. All right, so let's jump into what the rate reduction actually is and how it's handled. So when a lender gives you an interest rate quote, they look at things like your credit score, your down payment, and whether or not you're gonna be living in the property full time, or if it's a rental property, a second home. And they give you a rate quote based on those factors. This is based on a tiered system. So if you have a 740 credit score, you're gonna have the best rate with the lowest cost. If you have a 739 to 720, it's going to be slightly worse. And it's going to go down from there, down to 620, which is the minimum conventional credit score. So as an example, let's say you're buying a $300,000 house. You have a 740 credit score and you plan to put 3% down. You might be quoted an interest rate of 7% with no points or additional fees. But if you have a credit score of 620, you might be quoted an interest rate of, let's say, 8.25, or they might quote you where you have to pay 3% of the loan amount in additional fees. These are called interest rate points. That 3% or these additional fees are basically a charge for you having a lower credit score. You're being penalized for having your lower credit score. Most lenders, instead of charging you that fee, that 3% fee, they quote you the higher interest rate. So instead of your 7% interest rate, you're now at 8.25 or whatever it is at the time. Interest rates change daily. I said all that to say this new rate reduction program equals that playing field between the lower credit score borrower and the higher credit score borrower. It basically reduces the fees to get you closer to what it would be if you had the 740 credit score. So it basically makes it easier for lower credit score borrowers to get into a home. These are typically borrowers who have been greatly impacted by the interest rate hike because their interest rate is substantially higher than someone with a 740 credit score. We could have a debate on whether or not that should be the case, but this is making it a more even playing field. This also makes their monthly payment lower and it keeps a little bit more money in their pocket. The 700 plus borrowers will still have a slight rate reduction, but it doesn't help as much because you already have the best price and the lowest fees. Now, judging by some of the comments I've seen in other videos, people are misinterpreting what this actually means. I've seen some people comment like, maybe I should lower my credit score. That's not what you want to do because again, the baseline is the interest rate for the 740 credit score. So if you lower your credit score, you're basically just going to increase your interest rate still. What this program does is it brings the lower credit score borrower's interest rate closer to the baseline. And so let's put this into perspective real quick. If you have a 740 credit score and you're looking at buying a $300,000 house with 3% down, your interest rate might be around 7%. This isn't an actual rate quote, but let's go off of that baseline. Your monthly payment would be around $2,000 a month. But if you're working under those same things, meaning $300,000 house, 3% down, but you have a 620 credit score, your interest rate might be in the 8.5% range, which would make your payment about $2,200 to $2,300 a month, or about a $300 per month difference. On a 30-year loan, that's $108,000 more than if you just had a 740 credit score to begin with. And I get it. There should be an advantage to you having a 740 credit score. There should be a reason why having a good credit score matters. But this program doesn't impact people who have a 740 credit score, meaning it doesn't hurt them. It just helps people with a lower credit score. It doesn't take anything away from you for having a good credit score. You're just baseline. You keep it even, great, you have a good credit score, you get a good interest rate. It just helps prop up some of the people who don't yet have a good credit score and still want to buy a house without getting absolutely killed on the interest rate. And just to add, I know I'm probably going to get some questions about this, but this is not a government-funded taxpayer program where it's taking money out of the taxpayer's pocket or anything like that. This is a program where it just restructures how interest rates are calculated. It's more behind the scenes, but it's good to know about this program because you're going to want to be able to talk to your lender about the Home Ready, Home Possible, and standard 3% down conventional mortgage to make sure that you qualify and to make sure that you're able to take advantage of this rate reduction. Is there anything I missed? Comment down below if you have any questions. And if you want to find out more about great programs to help you get into a house, check out this playlist.